3 weeks ago, Kevin Warsh was sworn in as the 17th chair of the Federal Reserve. And the strategy his Fed is quietly working toward has the potential to shrink the real value of your mortgage, whether you ask for that or not. The mechanism is called financial repression. It's not a new idea. The government keeps interest rates below the inflation rate, and over time, the real value of debt shrinks. If you locked in a 3% mortgage back in 2021, and inflation is now running at 3.3%, that debt is already getting lighter in real terms. The government used this exact playbook after World War II to work down a national debt that had hit 120% of GDP. Today, with debt approaching that same level, the incentive to run that playbook again is very strong. But here's what most financial videos skip over entirely. This mechanism doesn't help everyone equally. If your income rises with inflation, you come out ahead. If your income is mostly fixed, a pension, Social Security, maybe some savings, inflation can quietly drain your cash flow even while your mortgage gets cheaper. Your payment stays flat. Your property taxes and insurance don't. So the real question isn't whether financial repression is happening. It is. The question is which side of it you're on and what you can do about it right now. Let's start with the math that actually tells you where you stand. Let's run the numbers on a concrete example, because this is where the story gets interesting. You have a $250,000 mortgage at 3%. Inflation is running at 3.3% year over year. In simple terms, the real value of that debt drops by roughly $8,250 in the first year alone. That's money the government is effectively absorbing on your behalf. On paper, that sounds like a win. But here's the trap, and it's the part that almost nobody talks about. That benefit only works if your income keeps pace with inflation. If you're a 62-year-old retiree drawing a fixed pension and Social Security, your income side doesn't inflate the same way. Social Security's cost of living adjustment for 2026 was 2.5%. Inflation is running higher than that. So you're already falling behind on purchasing power, even before you factor in anything else. Now add the real costs. Property taxes in most counties are assessed based on home value. Home values have gone up, so have insurance premiums. Take a couple like John and Mary, both 62, retired, with a $200,000 mortgage at 3.5%, a fixed pension of $3,000 a month, and Social Security of $2,500 a month. Over the past 2 years, their property taxes and homeowners insurance have gone up $400 a month. That's $4,800 a year. The inflation benefit on their mortgage? Maybe $7,000. So their net gain from financial repression is closer to $2,200, before accounting for any other rising costs like healthcare, utilities, or food. This isn't a small rounding error. It's the difference between feeling stable and feeling like you're slowly losing ground. And there's a bigger picture here too. The U.S. government spent over $970 billion just on interest payments in the past year. That number keeps growing as old debt rolls over at higher rates. The pressure to keep inflation elevated, to quietly reduce that burden, is enormous. The Fed under Warsh may talk about fighting inflation, but the structural incentives point in a very different direction. That's what the phrase financial repression actually means. The system is designed to transfer real wealth from savers and fixed income households toward borrowers and governments. This isn't about anyone being irresponsible. You did the right things. You saved, you bought a home, you locked in a low rate when rates were low. The rules of the game have shifted. Inflation now rewards borrowers whose incomes float upward and punishes those on fixed incomes. That's not a personal failure. That's a structural reality. So if the standard advice, keep your low-rate mortgage and let inflation work for you, doesn't hold up for fixed income retirees. What does? The answer starts with a playbook that's nearly 80 years old. After World War II, the United States was carrying a national debt of about 120% of GDP. That's roughly the same ratio the country is sitting at again today. The government didn't pay it down the traditional way, through spending cuts or tax hikes. It used a slower, quieter method. Regulation Q capped the interest rates that banks could pay on savings accounts. The Fed kept its benchmark rates low. Inflation, meanwhile, ran hotter. The result? Anyone holding savings was earning less than inflation was taking away. That's a negative real return, and it lasted for decades. From 1946 to the mid-1970s, the debt-to-GDP ratio fell from 120% down to roughly 30%. Financial repression did the heavy lifting. Now, savers in the post-war period didn't have many options. There was no high-yield savings account available online. Treasury inflation-protected securities didn't exist yet. Your choices were a savings account, a bond, or cash in a mattress, all of which were quietly losing purchasing power year after year. Today, the situation is structurally similar, but you have more tools. That's the difference that matters. I'll be honest about something. I used to think paying off your mortgage early was almost always the right move. I was wrong, at least when your rate is low enough that inflation is doing the work for you. At the same time, I wasn't entirely wrong either. Being debt-free in retirement carries a real kind of peace of mind that doesn't show up in a spreadsheet. The actual question isn't pay it off or don't. It's whether you're positioning the rest of your cash to keep pace with what inflation is quietly taking. The post-war playbook worked beautifully for the government. For savers with no inflation protection, it was a slow erosion. Over 30 years, you'd have watched your purchasing power shrink while the government's debt problem quietly disappeared. History doesn't repeat exactly, but the incentive structure is the same. Elevated debt, a Fed under political pressure, inflation running above the official interest rate. If you were designing a policy to quietly reduce debt without raising taxes, this is what it would look like. So if history tells us what's coming, the next question is what you actually do about it this week. Let's lay out two paths clearly, because this is where near retirees make very different choices, and the consequences play out over years. Path 1. You keep sending extra money toward your mortgage. You keep your savings in a traditional bank account earning around 0.1%. You pay the mortgage off early, feel good about it, and find yourself with a paid-off house but limited liquidity. Meanwhile, inflation has been quietly running at 3% or more. That cash you kept in the traditional account lost purchasing power every single year. Your property taxes kept rising, and you've got no cushion to absorb a big expense without touching investments or going back into debt. Path 2, you stop the extra mortgage payments, assuming your rate is under 5%. You move your savings to a high-yield account that's currently offering around 4% annually. You use the freed-up cash flow to build a real liquid buffer. You fight your property tax assessment when it comes up. You're not making any dramatic moves. You're just aligning your money with how the current environment actually works. Here's the math on why that matters. Say you've been putting an extra $500 a month toward a 3% mortgage. That's $6,000 a year. If that money instead sits in a high-yield account at 4%, you earn $240 a year in interest, and you keep the principal accessible. Over 10 years, the difference in compounded opportunity cost is over $3,000. That's not life-changing money on its own, but it's also not nothing. And liquidity has real value when something unexpected hits. The second path doesn't mean you ignore your mortgage. It means you stop treating it like an emergency when it's actually one of the cheapest dollars of debt you'll ever carry. I remember getting my property tax bill, and seeing it had gone up $1,800 in a single year. That was the moment it clicked for me. The mortgage wasn't the problem. The rising fixed costs I couldn't control. That was the actual squeeze. The mortgage payment was the one number in my housing budget that stayed exactly the same. The trade-off is real, though. Paying off the mortgage gives you emotional security. There's no payment. Nobody can take the house if you lose income. For some people, that peace of mind is worth more than the math says it should be. That's a legitimate choice. The question is whether you've also addressed the costs that keep rising regardless: property taxes, insurance, healthcare. If you pay off the mortgage but ignore those, you've solved the wrong problem. For fixed-income retirees, the resilience path has to include both sides: protecting your cash from inflation eating it quietly, and capping the costs that inflation is pushing up. But there's one piece of this that makes people uncomfortable, and that's the question of home equity. Let's get specific, because vague advice doesn't help anyone. Here are 4 concrete moves, 3 that almost everyone can make, and 1 for those with significant home equity. Move 1. Stop the extra mortgage payments if your rate is under 5%. This one feels counterintuitive, but the logic is clean. Every extra dollar you send to a 3% mortgage is a dollar working at a 3% return, guaranteed. If you can put that same dollar into a high-yield savings account at 4%, you're coming out ahead on a pure yield basis and keeping the cash accessible. If you're sending $500 extra a month, that's $6,000 a year. At 4% in a high-yield account, you'd earn $240 in interest, and you'd still have all $6,000 available if something breaks or an opportunity comes up. The mortgage at 3% isn't going to hurt you. Illiquidity will. Move 2. Move your idle cash to a high-yield savings account. Pull up your most recent bank statement right now. Find the interest rate on your savings account. If it's under 3.5%, you're leaving real money on the table. Online banks are currently offering around 4% annually on high-yield savings. That's not a small gap. On $50,000, sitting in a traditional bank at 0.1%, you're earning $5 a year. In a high-yield account at 4%, that same $50,000 earns $2,000 a year. That's $2,000 that doesn't require you to take on any more risk, any more work, or any new accounts beyond opening one. One important note: rates change. Banks have been quietly dropping rates when the Fed signals cuts. Check your rate every quarter and be ready to move. Move 3. Appeal your property tax assessment. This is the most overlooked move in the entire list. Most homeowners never appeal their property tax bill. They just pay it. But if home values in your area have risen significantly, the county may have assessed your home at a value that doesn't match what comparable homes are actually selling for. If the comparables don't support the assessment, you have grounds to appeal. The process varies by county, but in most cases, you go to your county assessor's website, look up your current assessed value, research recent sales of similar homes nearby, and file an appeal if the numbers don't match. It usually costs nothing to file. A successful appeal can save $500 to $2,000 a year, every year going forward. That's a permanent reduction in a cost that inflation keeps pushing up. I've done all of this myself. I stopped sending extra money to my 2.75% mortgage and put that money in a high-yield account instead. It felt wrong at first, like I was being financially irresponsible. But when I ran the numbers honestly, keeping that cash liquid and earning 4% made more sense than paying down debt that inflation was already eroding. The math won. Move 4. For those with significant equity, consider establishing a home equity line of credit. This one is optional and not right for everyone, but it's worth understanding. A home equity line of credit, a HELOC, gives you access to your home equity without requiring you to sell or refinance. If inflation keeps rising and you face a large unexpected expense, having that credit line established before you need, it gives you options you won't have if you wait until you're under pressure. A word of caution: a HELOC has a variable interest rate, which means your borrowing cost can rise. This is not a spending account. It's a liquidity backstop, a tool you establish and ideally never use. Some retirees with substantial equity also look at a reverse mortgage line of credit, which has different mechanics and no monthly payment requirement. Both options deserve a careful look with someone who can walk through the specific numbers for your situation. None of these moves require you to time the market, take on more risk, or make a dramatic change. They're adjustments to where your money sits and how your existing resources are positioned. Now, I know some of you watching have already paid off your mortgage, and there's a real chance you're feeling like you got this wrong. You didn't. If you already paid off your mortgage, I want to speak to you directly for a moment. There's a particular sting that comes from doing everything right, being disciplined, making sacrifices, paying off the debt, and then watching the financial conversation shift to actually, low-rate debt is a gift, don't pay it off. That feels like a betrayal, and I've seen people carry a quiet resentment about it. Here's the honest framing. You didn't make a mistake. You made a sound decision with the information and the values you had at the time. The rules of the environment shifted around you, not because you were wrong, but because the government's debt problem and the Fed's response to it changed the incentives. That's a structural change. It's not a grade on your financial discipline. Your paid-off home is actually a strength in a way most financial commentary misses. Your housing cost is essentially zero. Taxes and insurance, but no mortgage payment. That is real monthly cash flow that you keep regardless of what interest rates do, what inflation does, or what markets do. You have the freedom to take more risk elsewhere in your portfolio because your largest expense is locked. That's a genuine advantage. The behavioral pattern that does cause real damage is what happens next. The regret itself. Some people get stuck. They feel left behind, they stop making moves, and they watch their savings sit in a low-yield account because they're too frustrated or confused to act. That's where the real cost accumulates. I don't know every detail of your situation. Maybe paying off the mortgage was exactly the right move for your peace of mind, and that peace of mind has real value. But if you're watching this and feeling stuck, there are still things you can do. Dividend-paying stocks that grow their payout over time tend to keep pace with inflation. A small allocation to inflation-protected bonds. Even a tips ladder. These aren't exciting ideas, but they're the kind of moves that quietly work in your favor over the next decade. The same way financial repression quietly works against cash that isn't earning anything. Whether you still have a mortgage or you paid it off years ago, the next few years will test some long-held assumptions. Let me leave you with one final thought. Financial repression isn't a headline. It doesn't show up as a line item on your bank statement. It works quietly, through the gap between the inflation rate and what your savings are earning, through property tax bills that inch up every year, through a cost of living adjustment that doesn't quite keep up. The key to navigating this isn't a clever investment strategy. It's understanding your personal inflation rate. Not the government's official number, but the actual rate at which your specific expenses are rising. For most people near retirement, that number is higher than 3.3%. Healthcare costs rise faster. Property taxes rise faster. Insurance rises faster. Once you understand your real number, the decisions about where to hold cash, whether to make extra mortgage payments, and how to fight rising fixed costs become much clearer. The Fed's plan may quietly cancel the real value of your mortgage. That's the upside. The downside is that the same mechanism is quietly working on your cash and your income if you don't position for it. If you're someone who wants to protect your purchasing power in retirement without chasing risky investments, subscribe. I put out practical, no-hype content specifically for people in your situation. And I want to hear from you. Are you planning to keep your low-rate mortgage, or are you working to pay it off? Drop your answer in the comments. I read everyone. The Fed's plan may cancel your mortgage. It doesn't have to cancel your retirement. Know the numbers. Make your move.